Beginning your investment journey involves mapping out your financial goals and aligning your investment choices accordingly. This process entails a thorough understanding of your risk tolerance and managing that risk as you progress. To begin on this journey, recognizing your objectives is crucial. There are, of course, many types of investments including real estate, collectibles, cryptocurrencies and many more. We will focus on the most popular and lowest barrier to entry investments in this video. After determining your objectives, you have two paths: navigating the investment waters independently or seeking the expertise of a financial advisor. Let's delve into the essential steps to kick off your investment journey. Before starting any investment activities or opening an account, it's critical to first clarify your investment objectives. Are you in it for the long haul? Or are you seeking to generate regular income through your investments? Identifying your goals early on will help streamline your investment choices and simplify the entire process. Comprehending your investment goals and their respective timelines is crucial. Assessing the level of risk you're able to tolerate and deciding which investment accounts to prioritize is key. For instance, should your aim be to grow a retirement fund, selecting a tax-advantaged account like an individual retirement account or a 401k plan provided by your employer would be advisable. However, it's prudent not to allocate all your investment-designated funds into a 401k due to restrictions on accessing those funds before reaching the age of 59.5. It's unwise to invest your emergency funds in a brokerage account, as accessing these funds in an emergency can be challenging. Also, withdrawing your investment during a market slump could lead to potential losses by selling at a low point. Once you've identified your investment goals, the next step involves selecting the appropriate platforms or accounts for your investments. A combination of different accounts can effectively serve a singular goal. For those inclined towards a hands-on approach in managing their investments, starting with a brokerage account is recommended. These accounts provide the flexibility to trade stocks, mutual funds, and ETFs without restrictions on income, investment amounts, or withdrawal timings. However, they lack the tax benefits associated with retirement accounts. Various financial institutions, including Charles Schwab, Fidelity, and Vanguard, offer brokerage accounts. Opting for a traditional brokerage can afford you a broader selection of account types, such as individual retirement accounts or custodial accounts, alongside access to customer service. Yet, traditional brokerages might lag in adopting innovative features or niche investments like cryptocurrencies. Unlike fintech firms such as Robinhood or M1 Finance, which introduced fractional shares earlier than the conventional counterparts. For those with straightforward investment goals seeking a more hands-off approach, a robo-advisor might be the ideal choice. Robo-advisors stand out for their lower fees and automated portfolio rebalancing, among other benefits. However, if your financial goals are more intricate and you desire a tailored investment strategy, a robo-advisor might not suffice. It's crucial to note that merely opening and funding a brokerage account doesn't equate to investing. Remember, the actual investment process begins with making your first purchase. In the process of selecting your investment accounts, it's equally important to decide how much you intend to allocate to each type of account. The amount to invest in each account should align with your initial investment objectives and the timeline you have set to achieve these goals, often referred to as your time horizon. Be aware of any investment caps specific to certain accounts. Consider allocating a portion of your income towards your investment portfolio. A commonly suggested guideline for retirement savings is 15% of your annual income. However, if you began investing later in life or aim for an earlier retirement, a higher contribution might be necessary. Remember, this 15% includes any employer matching contributions, meaning you could invest 10% of your salary and receive a 5% match to meet this benchmark. If managing on a tight budget, the idea of setting aside 15% for investments might seem daunting. Starting with as little as 1% is better than not starting at all, allowing your investments to grow over time. Strategizing your investment approach raises the question: should you invest a lump sum immediately or spread out your investments over time, known as dollar cost averaging, DCA? Each strategy has its merits and drawbacks. Dollar cost averaging is a prudent approach for medium to long-term objectives, ensuring steady investment towards your goals and capitalizing on varying market prices. Even modest, regular investments can make DCA an effective strategy. However, DCA isn't without its critics. Given the market's tendency to rise over time, lump sum investments typically yield higher returns. Your target allocation is the ideal balance of stocks and bonds for your risk tolerance and investment duration. Most individuals, lacking substantial cash reserves, naturally gravitate towards DCA. The key is to start investing without delay rather than waiting for the perfect moment, which may never arrive. Opting for a lump sum investment doesn't preclude the benefit of regular contributions thereafter, enhancing your portfolio's growth potential. Risk tolerance is a measure of an investor's willingness to endure market volatility in pursuit of potential higher returns. It significantly influences the choice of assets within your investment portfolio. This evaluation is crucial since some investments are inherently more prone to rapid price changes. Utilizing a risk tolerance questionnaire is an effective method for determining your comfort level with risk. These questionnaires consist of a brief series of questions designed to gauge your risk tolerance based on your answers. Individuals with a conservative risk profile may lean towards a portfolio heavy in bonds and cash, whereas those with an aggressive risk stance might favor a larger allocation of stocks. When considering your risk tolerance, it's important to distinguish it from your risk capacity. While risk tolerance is about how much risk you're emotionally prepared to handle, risk capacity deals with your financial ability to endure risk. Risk capacity evaluates various factors that affect your financial resilience against risk, including employment status, caregiving responsibilities, and the time frame for achieving your financial goals. These considerations help ensure that your risk-taking is aligned with your broader life circumstances and financial capacities. Investing isn't a one-size-fits-all activity. Your desired investor identity should align with your risk tolerance and capacity, as certain strategies might necessitate a bolder approach. Investors typically align with one of two principal styles: short-term investing, often referred to as trading, and long-term investing. Short-term investing offers the allure of supplementing, or even replacing, your current income through the profits gained from buying and selling investments. However, this approach carries significant risks and challenges in achieving consistent profits due to the rapid fluctuations in the market and the unforeseen impact of news and announcements. Moreover, the tax implications differ between short-term and long-term investing strategies. According to the IRS, profits from assets bought and sold within a year are considered short-term and are taxed at a higher rate than those from long-term investments, which involve holding an asset for more than 1 year. After clarifying your objectives, gauging your risk appetite, determining your investment capital, and identifying your investor type, the next step is to construct your investment portfolio. This process involves choosing a mix of assets that aligns with your financial goals. Here's a breakdown of common investment types for your portfolio. Stocks. Representing a share of ownership in a company, the value of stocks tends to increase with the company's success but can decline if the company struggles. Bonds. Essentially loans to corporations or governments that promise to pay back the principal amount plus interest. While bonds typically offer a reliable income stream, their returns are generally lower than those of the stock market. Mutual funds. Pooled investments that aggregate funds from multiple shareholders to invest in a diversified portfolio of stocks and/or bonds. Mutual funds allow investors to hold a broad segment of the market in a single investment and can be either actively or passively managed. Actively managed funds have professional managers making investment choices, whereas passively managed funds aim to mirror the performance of a specific index, like the S&P 500. ETFs. Exchange-traded funds share similarities with mutual funds but often come with lower fees and greater flexibility in trading. It's crucial to keep an eye on and adjust your portfolio periodically throughout the year. Due to market dynamics, the initial composition of your investments will inevitably change over time. Take, for instance, if your strategy was to allocate 70% to stocks and 30% to bonds, market growth could skew this ratio to 80% stocks and 20% bonds. This phenomenon, known as portfolio drift, can inadvertently increase your risk exposure and affect your potential returns if not addressed. The act of rebalancing involves redistributing your investments to realign with your original targets. A common guideline is to rebalance whenever your portfolio deviates by more than 5% from its intended allocation. Exercise caution in reacting to significant market downturns. Such scenarios can prompt hasty decisions, like selling off investments during a slump. Subscribe for more information on investing and increasing your wealth. Good luck!